Hello, everyone, and welcome to this session on tax base without the current amount. And this is part three of the series I've been doing on deferred tax, and that in itself forms part of the overall IAS 12 tax accounting course. And if you recall from my previous videos, if you had a chance to go through them, I started by talking about deferred tax. I introduced the concept of deferred tax. I then went on to explain the concept of tax base, and we talked about how to determine the tax base of an asset and how to determine the tax base of a liability. And like I said in those videos, conceptually, the starting point of calculating deferred tax is to look through your balance sheet, identify the assets and liabilities. Each of them have a current value. And so for deferred tax purpose, you also need to imagine a tax basis balance sheet. And on that tax basis balance sheet, every item on your balance sheet, your assets and liabilities, appear on a tax basis balance sheet and they have a value. The value they have is called the tax base, which is why in those previous videos I talked about how to determine the tax base of an asset and liability, which you then place on the tax basis balance sheet. So to calculate your deferred tax, you need to look at your current value of each asset and liability, look at the tax base, the difference between those two, give you a temporary difference, and that forms the basis of calculating your deferred tax, which we'll cover in later sessions. Beyond your assets and liabilities that you find on your balance sheet, there are other items that do not appear on your balance sheet, but they have a tax base. And that's the focus of this video. And so for learning objectives, we want to understand why a tax base can exist even when the item does not have a current amount. I'm going to explore common scenarios under IFRS where these arise. And in looking through those scenarios, I'm going to apply a set of principles and hopefully helps you understand how to work this on your own in your practical lives. Then, as a closing point, I'll give practical tips on how to identify items with a tax base that don't have a current amount in real life situations. Hopefully, you find them useful. And I'm hoping that you achieve these objectives at the end of this session. If you don't fully achieve them, just drop a comment and I'll hopefully be able to answer your questions. So why will the tax base exist with a kind amount? Yeah, it happens in reality. But this principle is based on something the writers of IS-12 have said in paragraph 9 of IS-12. So they told us that there will be cases where you have a tax base on an item, but that item does not have a current value in the balance sheet. And the principle is this: deferred tax is based on stuff that have future tax consequences. So conceptually, we like to start from balance sheet because that's what IS-12 requires us to do. If for any reason an item is on the balance sheet but has a future tax consequence, we will still have to do the deferred tax calculations. But what some practitioners like to do, some experts have tried to look at it from a conceptual point of view, is to say that while these items do not apparently appear on your balance sheet, conceptually they have considered them to be assets. However, for because they have not met the recognition criteria of the relevant IFRS standard, then you will not see them on the balance sheet. So what they've said to themselves that yes, it has a value, but as it hasn't met those recognition criteria, you immediately write them off and it never makes it to your balance sheet. You never do a double entry for those items. So if this argument makes you happy, if it makes it comfortable, then you can go by it. But I think it's just okay to go through to stay with the principle or with the point made in paragraph 9 of IS-12 to say that look at those items that have a future tax consequence that gives you future tax benefits, but do not have a face value on your balance sheet. It's still a tax base. Just say that its current value is zero. So what I'm going to do now is to go through two scenarios that are quite common in practice and hopefully helps us to understand the points that I'm trying to make. So the first illustration is about research cost deducted over time, and I'm looking at a fictitious company in quotes, Xtech Limited. It doesn't exist. I've just made it up on my own. So X-Tech Limited incurred 600K in domestic research cost during the year ended 31 December 2024. Under IFRS, these costs must be expensed immediately in the income statement with no asset being recognized in the balance sheet. However, under the tax laws of Mosaic Republic, research costs are not fully deductible in the year incurred, but must be spread equally over 5 years. And so, what we want to find out in this illustration is to say what's the tax base of research costs for the year ended 31 December 2024 and for the next 4 years. And we're going to assume that no additional research costs are incurred during these periods we're looking at. So we're looking at 2024 to 2028. And so the next slide just, I mean, shows how I have solved this scenario, this illustration. So the question says, or the illustration says that 600K research cost was incurred in 2024, and that's why you can see 600K here. But nothing was incurred in the remaining 4 years, and that's why you see zero all through. The tax law says you have to deduct this expense evenly across 5 years from the year when you incurred them. And so 600K divided by 5 is 120K. And that's why the research expense allowed in the tax returns is 120K across each year from 2024 to 2028. But in 2024, we deducted only 120K. We know we've incurred 600K. So it means that we know that we have a remainder of 480K to be deducted in future years. And at 600K minus 120K, there's a 480K we need to carry forward. And I suspect that on the tax returns, you will need to disclose this amount to say to be deducted in future periods. And when you get to 2025, you deduct 120K and you carry 360K forward. You do it all the way through until you fully deduct it in 2028, and there's nothing else to carry forward at the end of 2028. From a tax accounting point of view, the question is what's the tax base? And in this session on tax base of an asset, I said that in in the simplest definition you can almost find is that the tax base of an asset is the value attributable to that asset that is deductible against future taxable profits. So this our imaginary asset in this case is research costs. What amount at the end of 2024, what value is attributable to research costs that we expect to deduct against future taxable profits? As the carry forward expense of 480K. That's what we expect to deduct in future. And this is assuming that there will be sufficient future taxable profits in future because there are certain rules that may stop us from recognizing this tax, I mean, the deferred tax consequence. But for now, we assume that there are no restrictions. And so the 480 is available to be deducted in future periods, and that forms our tax base at the end of 2024. And you follow that same principle to look at it from 2025. At the end of 2025, the carry forward is 360. We expect to deduct these amounts against our future taxable profit. So it's a tax. So that's the tax base of the imaginary asset, in this case, research cost. And it all the way till 2027, where your tax base is 120K, and by the end of 2028, no more tax base because you have fully deducted the 600K, 120K each year from 2024 to 2028. Simple illustration. I've demonstrated how you can have a tax base and you have nothing on the asset side or the liability side of your balance sheet. So we're going to look at another scenario here. And this second illustration is about equity settled share based payments. And the company we're looking at in this case is, of course, an imaginary company, and I've called that company Baba PLC. And at Baba PLC, employees were granted equity settled share options on 1st January 2023 with a 3-year vesting period. The total fair value of the options granted was £4.5 million, which is expensed evenly over the vesting period. It is assumed there are no forfeitures or changes in estimates. For the year ended 31 December 2023, the IFRS 2 expense is £1.5 million, Under UK tax rules, deduction is available until the options are exercised. The company expects a total tax deduction of £6 million in 2026 when employees are likely to exercise the options. So the requirement is determine the tax base at the end of the year 2023. And so we'll just look at the illustration now, the solution now. So the fair value of the share options is £4.5 million, but we've said it's going to be expensed evenly across a 3-year vesting period. And so if you take £4.5 million divided by 3, there would have been an expense in your books. So 1.5 million expense, and the other leg will go to a reserve, a special reserves. Nothing in your asset, nothing in your liability. So if you look at the asset side and the liability side of your balance sheet, you will not see anything for share-based payment. So if that's your starting point, you won't pick this up. From a tax returns perspective, we've said that in the UK legislation, there is no deduction available for share-based payments until the options are exercised. And in this case, the scenario says the options will be exercised in 2026. So it means in 2023, no deductions was allowed. Nothing would have been deductible. Every expense in the books would have been disallowed. So the 1.5 million would have been disallowed. That means the deduction was taken. But we know that based on what the accountant has calculated, we're expecting that by 2026, the deduction will be £6 million, and that's usually based on the market value of the shares at the end of the year. And so somebody has done the calculation. It's usually a lengthy calculation depending on the complexity of the share-based payment. And somebody has done the calculation and have said that your future share-based payment deduction is expected based on what we know as of end of 2023. We expect it to be £6 million, and that's what we know now. And so the question is, what's your tax base? And we're going back to the same principle. The tax base of an asset is an amount attributable to that asset that is deductible against future taxable profits. Based on what we know now, we expect to deduct £6.6 million, and that's going to be the tax base of the asset that we cannot see on the balance sheet. And that will be the second and final scenario I'll be looking at today. There are a couple of real life situations, many of them. I realistically cannot cover all of them in a short session. The point is, I've just tried to demonstrate that this happens in practice. But what I'm going to do to close the session is to give us a few tips on how to identify them in practice. So usually, for many transactions, when you put an expense in your books, when you debit expense, you usually credit a liability account. If you credit P&L, you are usually going to debit an asset account. But there are cases where it does not happen. And so your first check is to, do you have this kind of situations that do not create an asset or liability? That's the first check. The second check is, does this expense is usually an expense that where you have this situation. It almost never happens when you have a credit in your P&L. Almost never a problem. But it's almost always when it happens, it's usually because it's a charge in the P&L that does not create a liability on your balance sheet, or does not create an asset, whatever it is. Yeah. So when you have that situation where you have a charge, but you don't have a corresponding asset or liability, you also want to check is that, does this P&L entry, does it create a future tax consequence? As an accountant, you may not have the full answer. You then need to go back to check the tax legislation, the local rules to say that, does it create a future tax consequence? In many countries, there are only a handful of transactions that will fall under this scenario. It will be things like share-based payment, research costs, a couple of things as goodwill, depending on wherever you are operating from. There won't be a lot of them, but that will be the sensible check. What goes into my PLN does not give you a national liability. Is there a future tax consequence for this entry? If there is, then you're likely to have a tax base of an item that does not have a current amount. And so that will be all for this session. And in the next session, I'm then going to proceed to talk about temporary difference. As an intro, temporary difference is the difference between your tax base and your current value. And after talking about temporary difference, we'll talk about the recognition criteria, how to sometimes you have to unrecognize the temporary difference and stuff like that. If you have any questions, please drop them and I'll find some time to respond to them. Take care and bye bye.